Major markets, they are holding just near those record highs. The Dow, though, slipping a bit. Investors taking a breather from that rally ahead of Nvidia's earnings results out on Wednesday. The chip giant is the largest contributor to earnings growth in the S&P 500. Without it, the blended earnings growth rate for the index would fall from 5.7% to 3.2%. That's according to the latest data out from FactSet. To discuss how investors should position their portfolios ahead of the results, we want to bring in Brett Ewing. He is First Franklin Financial Chief Market Strategist. Brett, it's great to have you here. So talk to us, just is this or is it not a make or break moment here for the market in the context of Nvidia earnings out on Wednesday?
Well, I certainly think that's a big component, and it's going to play an important role here in the short term with the market. But I think the AI trend is a little bit longer term, and the market will likely recover. So just from a historical perspective, let's talk about where we are in the market right here. This is an election year. I know a lot of people may not know that, but we are in an election year. If you look back, going back to 1928, markets are positive in an election year over 83% of the time versus 69% of the time non-election years. Another thing I would like to point out is that, look, we are likely in a low Fed cut cycle right here. And that is absolutely Goldilocks for stock markets. If you go back and look at all the 8 cycles going back to 1950, and you look at all the slow cut rate cycles, the average return from the very first cut is about 23%. So I throw that out there for your viewers. I think those are some important facts to look at right here.
Well, I'm curious about your thoughts on the conviction behind that momentum that you look at historically. Do you think that this is a close your eyes, hold your nose, and buy environment?
I never think that, but I do believe we have a lot of positive tailwinds. Again, with the Fed, I think over the next 2 years, we're looking at areas in small and mid cap. I think that that's one of the least talked about areas of the market. And I think the opportunity there could be upside of over 40 to 60% over the next 18 months. And, you know, small and mid cap stocks, if you look at the Russell 2000, for example, it's been in a 24-month channel. It's been in a box. It's been trying to break out of that channel. It's attempted 5 times. The 6th attempt just recently here in March, it actually broke out of that channel. Now, that's the 4th longest streak of being trapped in the channel in its history.
Right.
And the longer they stay in, the more powerful the breakout could be.
But Brett, I'm curious about your take on that, because small caps are the ones that are most likely to be negatively impacted by higher for longer, given the amount of debt that they have and the inability to refinance. So how are they going to be able to withstand that headwind?
I think a lot of all that is priced in. As you can see, the recent move that we've had in the small cap index dating back to October of 23. I believe that a lot of that's already been priced in. And looking forward, the market is looking at rate cuts. And I think that's what the sentiment should be. And I think the opportunity of getting ahead of the first rate cut is very important with the small cap index.
Brett, within small caps, though, where are you seeing that investment opportunity?
You know, I think that it's spread out. So, you know, there are some small cap REITs we've taken a look at. You know, if you look at the Bank of America Global Fund Survey, you know, it's the lowest net investment into real estate that we've seen going back to 2009. It's a net 28% negative. We're looking at opportunities in some small cap REITs, actually, because it's baby with the bathwater syndrome. And there are actually some good companies out there that we feel will prevail as rates start coming down.
Well, Brett, I know that you think that we could have a couple of rate cuts this year, but rate cuts aren't necessarily good for stocks. I mean, you had Bostic saying this morning that getting down to, you know, a 0% rate environment would mean that there was a serious issue within our economy. So how do you think about 3 cuts and maintain the view that everything's going to be fine if we get those 3 cuts?
So when we talk about Fed cuts and the different cycles, I like to break it down in a couple different areas. There's a cycle where the Fed goes nice, methodically, and slowly through the rate cut cycle. And there's some where the Fed cuts really quick. I don't believe we're in the category where they cut quick. The reason why they cut quick is because they've made a mistake. Essentially, they missed it. And usually in that environment, that would be like a 2008, 2009, other historical eras where there's a big crash and they're reacting to it. That is not where in the camp that we believe we're in. We believe we're in a slow cycle, and that is the ideal environment for the stock market.